Back in May, my guest today sat right here in the studios and gave us some very uncomfortable numbers. A GDP cut to 6.6%, a currency account deficit story India had never seen before, and a warning that India's $80 billion, or rather $180 billion IT export engine could be quietly disrupted by AI. 2 months on, some of those warnings are playing out in the data in real time. The monsoon has turned out weaker than hoped, food inflation is ticking back up, and the current account deficit is tracking wider than even his own estimate. Sameeran Chakraborty is back with us to tell us how much of what he predicted has come true and what changes from here. Sameeran, welcome to the interview once again. Thanks for your time.
Thank you. Thanks for having me again.
Sameeran, what I want to really start off with, the fact that in May when we were chatting last, you flagged off the real risk of CPI crossing 5% if fuel hikes exceeded 5 rupees, and the monsoon disappointed. June CPI has come in at 4.4%, and the rainfall deficit is for all of us to see. It's now widened sharply. Are we tracking toward that 5% breach, or has the RBI's own upward revision already priced that in?
So obviously, the headline inflation number would increase much beyond the 5% as we move in the latter part of the year. But that's partly just because of the unfavorable base effect of last year. You would recall that around September, October, the GST cut was done, which had a positive effect on the inflation numbers. This year, that will be on the base, and to that extent, the headline numbers would look higher. But I think that's not the main issue that markets should focus on. There are three different things that are there. One is to what extent this cooling off of energy prices, which happened after the ceasefire, to what extent that will last versus whether there could be any renewed energy price shocks or not. The second is that we know that the monsoon is tracking much lower than normal, but it's not yet as much visible in food prices. So at what point of time any food price shock will be visible in the data? And the third one is that the economy has been quite resilient, the demand side of the economy. Till now, we haven't seen that much of pass-through of raw material cost increases into core inflation. Is this a more lagged story? And to what extent the core inflation numbers stay higher than usual? I think these are the three things that I would be watching more closely now.
Sameeran, I was just going through your latest research, and that calls wages an underappreciated tool and a driver of consumption green shoots. Tell me, what is the prognosis for this?
Yeah, it's a very interesting thing that India does not have a kind of one particular wage data which everyone can track. So you have to glean it out of multiple sources. So in this report, we have tried doing that using both mostly the official estimates and some private estimates. So what we are figuring out is that something changed around 2025, and then it's following through in 2026 also, is that in multiple ways, there has been improvement in wages, not only in our tracker of about 4,700 listed companies' wage cost data, where the wage cost growth has been better in 2025, or rather FY26 vis-a-vis FY25, but also in the government's PLFS data, we have seen increase in wages, particularly for the salaried class. And now we are seeing across the board in quite a few states a substantial increase in minimum wages that have been done. And now how quickly that gets translated into other states also doing the same, and at the low end of the private sector also sometimes gets impacted their wages by this change in minimum wages by the state governments. And then once this minimum wage revision process is behind us, then next year is the 8th Central Pay Commission year, So we have done some estimates on how much of a wage increase could happen next year. So in all, from 2025, 26, and 27, all 3 years looks like there would be substantial increase in wages, which could be one of the reasons why consumption side of the economy has held up quite well.
Interesting. And you've also made the point that Karnataka's minimum wages are up 50 to 60%, Haryana 40%, and Uttar Pradesh 28%, against a usual annual trend of just about 6%. What does this kind of state-led wage shock do to manufacturing competitiveness versus its, of course, boost to consumption?
Yeah, it's always a difficult balancing game, right? We have to look at it that for the minimum wage is two component. One is the base wage, the other is the variable dearness allowance, or the VDA. The states usually only increase wages to the extent of this VDA and not change the base wages for a very long period of time. So in some sense, one can say that this was due, and after this new code on wages that has come in from November 2025, I think most states are now going ahead and doing that base wage revision, and that's leading to this one-time shift. So yes, I mean there will be some pressure of this into the overall wage cost for companies. But the point that I was trying to mention is that there's no perfect correlation between minimum wages and any other wages. Minimum wages are more kind of statutory in nature. It's more a guidance than anything else. The central government is working on fixing a national floor level minimum wage, which will be kind of binding on states to follow. But that process is still on. But to me, the big question is that how quickly this gets translated into actual wages on ground.
But tell me, what could be the implications or the multiplier effect of this? Because you write in your notes that the 8th Pay Commission's fiscal impulse is going to run to about 1 to 2% of GDP over FY 28 to 29, even at a conservative fitment factor of 2.5 odd percent. Tell me, what happens to the fiscal math then, and then to inflation?
Yeah, so this is obviously every time this pay commission happens every 10 years, this is a shock that the fiscal will have to absorb. I'm pretty sure that everybody in the scheme of things are well aware of this. So there are multiple ways to address this. In past, we have written about it that one of the ways to do it is to use some of the cushion that is there in the RBI's balance sheet and transfer a bit extra money for one particular year as RBI dividend to the government, and through that plug the hole. There are other ways of doing the area payment in tranches so that it gets the fiscal impulse is spread over multiple years. And you could think of doing larger amount of divestment also on particular years. There are multiple ways to address this, but it's quite clear that once this fiscal impulse comes in, if our numbers are anywhere close to right, then there will be a big consumption boost also, and in turn that should increase tax revenue as well.
But just to draw a deduction here, Sameeran, is there any which way that the wage story could undercut the consumption recovery story rather than support it? Or should one assume the wage story being a big tailwind to the consumption story?
So for us, it appears to be a big tailwind for sure. I mean, our equity analysts are constantly upgrading different consumer stocks at a time when we thought that because of this energy crisis, the Middle East crisis, there will be pressure on consumption as well, with fuel prices, etc., going up. But that has not happened. I mean, in fact, one of the reasons for our inquiry into this whole wage process was to better understand that what is making consumption hold up so nicely. One part could be that we have given, both from fiscal and monetary policy side, a large amount of stimulus in 2025. We estimate that the income tax cut, GST cut, rate cut, CRR cut, everything combined is about 1.3% of GDP total stimulus that has been given. So we are seeing that stimulus pass through the system now, as well as this wage part. And another part also needs to be discussed, which is that the consumer credit has also grown quite substantially. So if you put all of this together, the consumption side of the economy looks to be holding up or been much more resilient in the face of multiple external shocks.
You've always flagged off is AI and the automation story as a key downside risk to wages in IT and financial services. And, flagging it off from the Aon data, which already shows tech consulting salary growth slowing to about 6.6% for 2026. Is this the first hard evidence of the AI disruption you did warn about back in May?
But there are obviously, everybody can look at it with different lenses. But just to first put the numbers in context, that 4,700 listed companies' wage cost data that we track, what is interesting is that, and it's kind of the total wage cost for these 4,700 listed companies is 18 lakh crores of rupees. So it's a big number. What we find is that almost 50%, 48% to be precise, comes from just the IT and finance sectors. So there is a heavy concentration in that white collar jobs from just two sectors. And these two sectors are the most likely getting disrupted by this automation AI kind of stories. So I can see that different people are writing about the employment numbers also. When these company results come out, they declare whether there's enough job growth in these companies or not. So that's one way to track how much impact is coming. But we thought that another way to look at the same thing could be the overall wage cost number, which is nothing but the employment multiplied by the actual wages being paid. Another way to track this would be the monthly service exports numbers. We are watching this also quite closely. Last 2 months, the service export growth has been somewhat more tepid. Before that, we were saying that service exports are growing at double digits. So from there, the sudden deceleration in growth is something that I think we need to all watch out for very closely, because it has implications not just for the BOP, but the overall consumption story as well.
Sameeran, the El Nino intensifying and, rainfall deficit is widening through June and July as well. How much of the food inflation uptake, cereals, protein, edible oil, is monsoon driven versus the wage-led demand pull that you're now describing?
I think it's pretty very, very early to say it's a demand pull. It's if at all, this is more a supply side shock that we have to be concerned about. Having said that, we've looked at this data historically on in drought years, what kind of food prices get impacted. It's not a big surprise that actually food grain prices don't get impacted as much. The stock of food grains that we have, rice, wheat, etc., is so large that it's relatively easy for the government to provide those stocks into market supply and then keep prices under check. If at all, the price impact is visible more for items like pulses, oil seeds, and vegetables. So the critical question for us market analysts is that at what point of time would this be visible? We had a very good winter crop. So it is possible that that winter crop of vegetables will last us all the way up to even September. So maybe, if at all, the price impact is visible more from October onwards. The counter thesis is that if the rainfall deficiency is this large would some speculative element build up happen in prices like vegetable prices, where the price increase will be much before what the supply-demand balance would suggest. So that's something that we are very consciously watching. We have taken about 40, 50 basis point of additional just El Nino related effect on food prices into our inflation forecast. But given how the actual rainfall pattern will play out, we might have to either up that number or lower that number. So that's kind of the baseline forecast that we have for now.
Sameeran, you've called this the third consecutive BOP deficit year, unprecedented for India so far. The current account deficit is now tracking near 1.5% of GDP for the quarter, wider than your earlier full-year estimate. Is the deterioration happening faster than you anticipated?
I would say that our BOP numbers have gone through a massive transformation just because of the new schemes that RBI has announced to get the one-time dollar inflows. The FCNRB scheme, the ECB scheme, as well as the OFCB scheme for banks borrowing. All three schemes put together, we are thinking at least $60 billion could easily come in a very short span of time. So in some sense, the entire BOP deficit forecast that we had when we last spoke, that can be easily covered by these inflows. On top of it, oil prices have also come off quite materially from the numbers that we had seen in May. So our global oil strategists are now looking at oil at 70 or below. And in that sense, it's a very good news for India. Our own current account deficit forecasts have been materially reduced based on that lower oil prices. We are now probably, in our forecast sense, tracking below 1% of GDP current account deficit. So if you put all of this together, we are now closer to $45 billion BOP surplus forecast for FY27 rather than the $50 billion BOP deficit that we were looking earlier. So I would say this external sector outlook has gone through a pretty sharp turnaround because of partly how the geopolitics situation globally has changed and partly because of the policy measures taken by RBI.
And how are you maneuvering through that? Because once again, West Asia seems to be on the boil, and oil prices, after having cooled off all the way to sub 70, are back at 85 as we speak.
Yeah, obviously, as forecasters, it's quite a nightmarish situation for us especially when we have to do more medium-term forecasts on things. It's not an easy thing, and as you know, that oil price is something which affects almost every bit of macro forecast in India, whether it is growth, inflation, current account, balance of payment, everywhere. The oil price assumption is a very crucial assumption. I would say that this is one of those times when we have to be very nimble in adjusting our forecasts whenever the data changes, whenever the information changes. We can't just stick to one number because it's very difficult to know for sure where this is all headed. Our commodity team has not yet revised up their oil price forecast in this recent move. The expectation is still that this will get resolved and oil prices will come back to 70 or below, which has been their forecast in the past.
But Sameeran, tell me, what role do you see the RBI, addressing right now? I mean, the RBI faces a genuine growth versus inflation dilemma, or would you say it is the wage effect, which is too gradual to move the needle on rates?
So I would say that the growth numbers have held up better than what people would have feared, despite this Middle East conflict. Our sense is that the April-June quarter GDP is now tracking close to 7%. So that's not a bad number given the extent of the shock. Now, we don't know how much impact will be there on the economy from the monsoon side. That's obviously remains an unknown. But for now, going into the August policy, I think RBI would be less concerned upon growth compared to where they were in the June policy. Similarly, on inflation side, if you look at the April-June quarter inflation, when the final numbers have now come out, and they are 30 basis point on an average lower than what the RBI's forecast for the quarter has been. So even on inflation, the RBI has got some good news that the tracking of inflation is not as bad as what they have feared. Also, RBI had taken $95 as their average oil price forecast during the June policy. I know that there is a lot of uncertainty around this, but most likely they will be now considering a lower average oil price forecast for FY27 than in June. So that could also, in our view, reduce the average inflation forecast for them from 5.1 to about 20 odd basis point lower. So RBI can stay in this wait and watch stance that they have for now, giving a clear guidance that there's no need to act right now. There is no, as such, sign of demand-led core inflation increase, no sign that the second round effects of these energy and food price shocks are playing through the system. So I think wait and watch is probably the best strategy that they will take in this meeting. Obviously, a lot of discussion will be around how to manage the FCNR related issues, both from a currency perspective as well as from liquidity perspective.
I was going to come to that. Is the rupee now bearing more pressure than the RBI is comfortable admitting?
So this is where our current forecast versus where the markets are. There is a gap between the two. We still think that given the starting point of announcing all these measures where that the currency is undervalued, it makes sense for RBI to utilize these inflows to make the currency move lower, appreciate the rupee to some extent, a one-time adjustment, if you want to call it that way. Because we all know that given the inflation differential that we have with the rest of the world, over the more medium term, there would be some gradual rupee depreciation. That's okay. But if we are starting from a more fair valued currency, then that depreciation process is also much more easier for the markets to digest. Now, we haven't yet seen that much of an impact, the announcement effect of this scheme on the INR market. In 2013, the announcement effect was almost immediate. Within the first 10 days itself, a pretty large amount of INR appreciation happened. But that is not how it played out this time. So, but we have to also understand that the bulk of the inflows typically are somewhat back loaded. So when these inflows come in, there is still a possibility that that appreciation, that one-time reset that happens, and then RBI gets a relatively larger FX reserves, a relatively cleaner forward book through which they can give a signal to the market that the extent of depreciation would not be as much as what we have seen in the recent past. We'll have a much more gradual, more controlled depreciation path for the currency.
So lastly, Sameeran, if you had to redo your May scorecard today, growth, inflation, currency, current account, which call has surprised you most? And does this wage data change any of those calls going forward? What's the scorecard going to look like now?
Quite obvious that quite a few things have materially changed. The geopolitics is looking much better. The policy intervention has been much stronger than probably what markets would have anticipated at that time. And the fact that there has been some inherent resilience in the economy, wages is just one of them, credit is another part of it. And these factors have made the growth situation to be much better. In fact, even in May, if you remember, I used to say that there are two things working for India well. One is India does not produce any power out of natural gas. And second is that India has massive stock of petrol and diesel because it's a refining country. That's why power and mobility, two of the most important things on growth, were not impacted. So all in all, because the growth has held up well, we have managed this crisis period much better. but it's not that there cannot be any more shock. We discussed the El Nino shock is still just playing out. There could be shock from AI automation side as well. So we have to be very careful on all the macro forecasts, but clearly compared to where our numbers were in May versus where it is today, we have upped our growth forecast. We have brought down our inflation forecast. We have brought down our current account deficit forecast and made our rupee forecast also more optimistic than what it was in May.
Right. Sameeran, as always, refreshingly direct. Thank you for coming back and giving us the update on the economy.
Thank you so much. Thanks for having me.
Thank you. Thank you for your time.